some teeth pulled? Anybody? Put your hands down. We're not at the dentist. We're not getting our teeth pulled. This is a very light conversation around dinner. And we're welcoming you guys into the family. Now, finances is personal. It touches so many parts of our lives, and we're going to touch on a few of them. Kind of understand, as you guys are starting to approach adulthood, getting into your careers, how to start optimizing these things. Okay? So, first, cash flow. Cash flow is like blood is to your body. It touches every part of your financial well-being. So, healthy blood makes a healthy body. Healthy cash flow makes a healthy financial plan. So, some principles that are very easy to understand. We want to enhance your income. We want to minimize your expenses. We want to optimize the surplus. What does that look like? We're talking about enhancing your income. I really believe at the center of people's need for income is creating value for other people. How do you do that very well? Well, it's personal. It's individual for everybody. So I think that like somebody's calling and somebody's area that they develop the most income, but also like a real purpose in life is at the intersection of three things: affinity, ability, and opportunity. Affinity would say, what does your heart cry out for? Who are the people that you desperately want to serve? Another way to put this off, what areas of the world really upset you? What areas do you want to make a difference in? Ability says, what am I naturally already good at? So it would be a good thing to go and ask your best friends and say, hey, what do you think I'm the best at? What are the top 2 or 3 things where you think I'm naturally gifted? The last one is opportunity. And this is kind of like who's near you, who's around you. Seeing what's open in your network. Who has an opportunity, who has a job that you can go and just pop into and see, kind of experiment with what that opportunity looks like. And right in the center here, if you combine all these three things, give you a personal example. I hate that my industry is so complex and doesn't make things simple, the financial industry. I'm I'd say naturally good at understanding numbers, and I love people. And when I started this journey, I had a friend who put me in touch with the finance industry. So, like for me, this has become a calling, something that I love to do. Next, we're going to go to minimizing your expenses. Well, really, it's going to be a little bit different than minimizing, but you'll see what I mean. There's 5 competing uses of your income. And there's really only 5 things that your income can do. You can give it away. You can pay it in taxes, which nobody likes doing. Boo, that's right. You can pay debts off. You can pay some in lifestyle. And you can save the rest. Now, we think that there is a best order of operations here. But again, highlighted here, there's only 5 things that your current income can do, and we want to make things simple. So, the worldly pattern, and I know this is a bit a lot of words here, but the worldly pattern would say, I'm going to acquire, I'm going to enjoy, so prioritizing lifestyle, then I'm going to pay my debts, then I'm going to pay taxes. If I can save, I'll save, and whatever's left, I might give. At the very end, we're going to plan. Well, we flip that to the stewardship principle, where we're being very intentional about how we manage money. So, I firmly believe that when we dedicate everything to the Lord, and this is from my personal background, but I think when we dedicate and have a plan first, we can then start giving to our community. I think it's really important to prioritize giving first. There's a lot of data that I can point to, but with today's time, I want to be mindful of everybody's time. Suffice it to say, there's a lot of fulfillment in this giving piece. The next after giving would be savings. And I'll mention in a moment how we do the savings, but we want to do that first. Then we pay our taxes. Then we go and pay our debts. At the very end, we take lifestyle as the last form. It's really important that lifestyle goes last because there's all kinds of things that people can spend on, right? If you guys have seen your own Amazon carts lately, or your travel budgets, or whatever it might be, you can see there's so many things to spend money on. But we want to prioritize the steward's pattern to provide more fulfillment and enjoyment in lifestyle in your life. So, last but not least, we're going to optimize the savings. So this is, I think, really important when we talk about the savings component from this last slide. It is, how do you actually do that? The idea is income minus expenses equals your surplus. I think there's an ideal order of operations here where we go from operating account, that's about 1 month's worth of expenses. Very simply, that's your checking account. You put money in there, all the income goes into your operating account, your checking account, at the beginning of every month, and whatever you don't spend goes into the next bucket. Next bucket there is really important. We call that the emergency fund. That's essentially 3 to 6 months worth of expenses because life happens. We call those the 2x4s of life. They just come and knock us upside the head. We want to plan for life happening. Whether that be a flat tire on the side of the road to something as serious as a diagnosis. We need to have money in readily available emergency funds. I usually recommend just keeping that in some sort of savings, maybe a high yield savings, something that's easy to get to. The third bucket here is long-term goals. Now, we would recommend about 15 to 25% of your after-tax income goes into your long-term savings goals. For most people, 15 to 25% is really going to get you to a place, especially at your ages, is going to get you to a place where you have plenty left at your retirement date, and that would be a great time to come see us, right? We've modeled it over and over again. You can go into Financial Calculator and see even like saving $100, $300, $500 a month can turn into $1 million over the course of somebody's career. It's really quite incredible what you find with just compound interest. The last one we call short-term goals. This is kind of back to the pattern here. That would kind of be in the lifestyle aspect. And this is like big stuff. Like we want to buy a cooler car, or maybe we want to go and buy a house. Maybe we want to do some of these bigger purchases. Well, those can all go into short-term goals. And it can be a separate fund once you've prioritized your short-term needs and your long-term goals, then we can say, okay, let's go have some fun with the balance. Because life is not just about boring numbers and talking to people like me. It also is having some fun too.
So, can I ask, can you suggest something? I tell my daughter, for example, once she starts making money, hopefully soon, okay, take 20%. In other words, basically do everything with 28% what she makes. With 20%, which will be the emergency, long-term, and short-term.
Yeah, exactly.
That's a very simple rule.
Just very, yes.
80-20.
I know a lot of different rules. There's like the 10-10-80, there's 10-20-70. There's all these different percentages that you can layer on top of your own finances, but we try to make it like you're saying, as simple as
Very
possible.
simple.
Exactly right. All right. So next thing I'm going to do, as we're talking about how your finances should be structured. Coming from the accounting background, I usually see people's finances as an income statement and a balance sheet. So when your income statement is healthy and you have savings, it increases your balance sheet. Now, there's some gray hairs in the room, and you guys know that when your balance sheet gets healthy enough and you can retire one day, it actually starts to feed your income statement. It starts to go the other way. For most of us, we're looking at how do we turn our income statement into a balance sheet. We want to ultimately build your net worth. Net worth is very simple. It is your assets minus your liabilities. Assets is everything you own. Liabilities is everything you owe. So, give a very simple illustration here. We've got a whole bunch of different line items on what a balance sheet might look like for a family. But as we were talking about a moment ago, your savings priorities, those are all your assets, right? We're going to get to liabilities in just a moment. But our principle here is you want to increase your assets, you want to minimize your liabilities. That's the way to build your net worth. Your net worth is really the, I would say, most relevant financial number that you guys are trying to prioritize. How can we make all these decisions around your money so that your net worth can increase? Over time, your assets can start increasing themselves. That's called compound interest, something Lewis will talk about in a moment. But we're trying to, again, increase assets, decrease liabilities. Now, one of those big things that is very in vogue or in conversation today is home buying. I know a lot of us are wanting to go out and buy a home. Everybody tells you, all of our parents tell us, like, you gotta buy a home. It's the American dream. It's the kind of the American way. We need to have somewhere that we can raise a family, have 2.5 kids, and 3 dogs, right? That's kind of what everybody tells you. But have you ever considered like how to analyze what's a good purchase or not? A lot of people don't tell you this, but we're here to make it very simple. Buying versus renting. There's all kinds of headlines today saying that home affordability is at an all-time low. We want to say not to be discouraged. It's a little bit simpler than you might think. It just might take some time, and it might take some patience, and that's okay. If you do this the right way, you will be miles ahead of your peers. If you do this the wrong way, you can find yourself upside down in a home that you can't afford, and you're going to have a bad time. Nobody wants to have a bad time. So, when would I buy versus when would I rent? I use the 7% rule. Very simple way to analyze whether or not this home is good for me to rent or buy. Give an example. Or I'll explain how that works. The home purchase price multiplied by 7% is about what a home will cost you over the course of your investing in that home, kind of in the long term. Usually we find that in property tax, home insurance, and some costs, or the difference between your investment and the home growth. There's a percentage there. So, if you have a $200,000 home, 7% of that is about $14,000 a year. I would comfortably say that if you have a rent that is less than $14,000 in that same home, you should rent that home. Whereas if the rent of that home is, let's say, $16,000 or $20,000 per year, then you would want to say buying is a better idea for that specific home. Okay, so that's something that's really important nowadays. As you guys are making that decision on whether to rent or whether to buy, usually look at the costs, because there's all these hidden costs that not too many people tell you about. The thing about buying a first home, for a very long time, we've always been told you have to get 20% in order to buy your first home. We usually recommend that if you can get somewhere between 5 and 20%, that's a reasonable amount for a down payment. A down payment is simply the amount that you put into your first home. It's basically the amount you save up in your short-term savings bucket to go and apply towards the balance. If you can get up to 20%, that's the gold standard. That's where you eliminate PMI. PMI is private mortgage insurance. It's basically the bank's insurance against you defaulting on them. You're paying the bank to insure against yourself. It's a little bit of a bet against yourself. We don't want to do that if we can avoid it. A payment. I ran these numbers just a moment ago, but when we look at analyzing how much your monthly payment should be, we're usually recommending that you're less than 25% of your before tax income. So, give you an example. If a married couple both makes $50,000 a year, they make $100,000 as a married couple, they would be allowed to spend $25,000 a year, which is $2,083 per month. Today, at a 6% interest rate, which is fairly standard, might be a little low, but it's about close to what you can get in the market, and at a 20% down payment, the most house that they would be able to afford is a $350,000 house. I'm not sure if anybody is in the house market like I am, but finding a $350,000 house is not very simple. And having a $100,000 income is even a little bit above the median income. So house hunting is tough today, but you're looking for the right deal. You're looking for the home in the area that you can afford and at the price that you can afford. We don't want to violate these principles, or else you're going to have a bad time. And the last thing we talk about in first-time home buying is making sure that you can have at least 7 years that you spend in that home. I like to say 10 is even better, but you should be staying in that place for at least 7 years. The reason is you can go through these market cycles where the housing market might go up and down, and you can weather the storm there. The last thing here is a few kind of nuanced points about home buying. It's not really an investment. I know that's maybe counter-cultural, but I really think that home buying is more of a lifestyle choice, more of a personal choice. It's more like we want the freedom to make repairs on our homes. We want the freedom to do more things with or we want to go into the neighborhood that we like. It's again, a little bit more of a lifestyle decision. There's this private ownership versus flexibility. So renting might be a good idea if you're moving across the country, right? If you're not sure where you're going to land in your career. If you're wanting that extra flexibility, that might be good to rent versus to buy. And lastly, you got to ask the question, who pays the expenses? So when you own a home, the first time your water heater goes, that's a pain in the butt. The second time the water heater goes, you're like, why do I even own a home? But you'll find that there's all these expenses that you are now responsible for that you're just not paying when you're renting. Last but not least, on the actually two more things. So very principled, when we talk about general investments, we think of the three-legged stool. We build it on investments, which is something that we do. Real estate, which is, purchasing land or homes to produce income for you and to provide some safety nets for you, and business interests. So anybody that's entrepreneurial in the room, it is usually a very good thing to own your own business because you build the value of that business over time, which becomes part of your net worth as well. Last but not least, I'm going to run through this a little bit quickly, but I personally am allergic to debts, so I'll just tell you my own, kind of air out my own mail there, but there are debts that are more or less acceptable. I usually say a mortgage on a primary residence is an acceptable mortgage or an acceptable loan. Most other ones I would steer clear from. I still think it's possible to go to school without purchasing student loans. I would always always pay off your medical debts as absolutely as soon as possible. Credit cards, if you're not paying them off every month, you should not have a credit card. Car loans, I don't think that they're a very good thing, and I still think that you can go and buy cars for cash today. If somebody tells you that you're always going to have a car payment, tell them they're wrong, because it's just not a true thing in today's world. There are some potentially acceptable metrics in when you find yourself in this other consumer debt. What we're trying to do is minimize these things, because at the end of the day, debt always bets against the future. And the future is uncertain. We don't know where we're going to be tomorrow. We don't know what the future holds. So I would rather go into the future being confident with my net worth high rather than my debts high. Lastly, I know that a lot of folks talk about the FICO score. Last point I'll make is that your FICO score is not a good financial measure of your financial health. Somebody says, oh, I've got an 800 FICO score. That really doesn't tell me very much about their overall position, because they might have $1 million in debt and $1 million in assets. They might have zero net worth, and they might have an 800 credit score. So, as you're working through this whole plan, we can always go into the details kind of one-on-one, but I would try to maximize your net worth by, again, increasing your assets, lowering your liabilities. Now, I'm going to pass it off to my buddy Lewis. He sits next to me every single day, and he is much smarter than I am, so you guys are in for a treat to talk about investment basics.
Appreciate it, Josiah. All right, guys. Thank you all for coming out here tonight. I naturally project, so please feel free to tell Katie to turn off my mic if it's weird. I'm not going to be offended. What I'm going to talk about tonight is just some of our investment basics. We're going to kind of start ground floor, maybe get a little bit more into what are some of the key drivers of returns. And then finally, I want to bring it all together into, okay, what does this actually look like in a portfolio? All right, so going to start simple, might build up a little bit. I think it's a good opportunity to get us some good questions out here at the end. But first thing that we have to think about when we consider investing is, why are we doing it, right? It's everyone tells you have to do it, you should be doing it. And there's really three basic reasons. You may feel one of these more than the others, depending on where you are in life. But the first that I want to point out is to preserve your purchasing power, right? What does that mean? When we think about this, we're really talking about inflation. All right, so I think about it, and I actually, when I was in college, pro-college kid, I was buying McDoubles. So back in 2014, my junior year of college, it was exactly $1. It was great. It was like, cool, I got $5. I can afford a few burgers. I checked the McDonald's app today. It's $2.79, right? Doesn't sound like, oh, okay, $2.79, that's still cheap. Sure, but that represents a 179% increase in about 12 years. Okay, that's a simplified example of this, but this is happening with anything that you're purchasing, right? Your parents sometimes feel it because they see these high periods of inflation, low periods of inflation. Big theme here is, hey, 20 years from now, everything's going to be a lot more expensive, and your dollar today is not going to buy you what a dollar buys you today. All right, so that's reason number one. Number two, we just got to grow this money, right? Why not? If we're able to save some money over a long period of time, and we can grow our wealth, it can help us achieve our goals throughout life, right? So like purchasing a home, taking nice vacations, like starting a family. But ultimately, what we want to get to is creating this financial freedom and flexibility. All right, so you may see that now with some of your parents if they're retired. They worked all their lives. They get to experience that financial freedom this is really something that we want to, Chip knows. We want to experience this, we just know that it takes some time to get there. So these are 3 primary reasons that we would want to invest when we're thinking about it in the context of a financial plan. Alright, so what does this look like in real numbers? You heard Josiah talk about compound interest, we call it the 8th wonder of the world, because the sooner you start, the more you can get out of this over a long period of time. Right, so this graph, super simple, it's just saying, hey, if I'm 20 years old right now, and I put away $500 a month, and it's growing at 7%, how much money does that represent to me at age 65? You can see here on the left-hand side, it's about $900,000. All right, let's take the other end of the board here. If I started saving the same amount at age 40, what does that represent to me at age 65? Well, about $160,000. The difference here, guys, and to put this into perspective, my total amount invested from 20 to 65 was $270,000 in total, right? Just putting my money away monthly. That grew over time to $900,000. At age 40, running that same calculation, I put in $150,000. Great job, it's $160,000 now. It's the difference between $900,000 and $160,000, and it's all depending on how early you can start putting some money away towards your investments. Now, let's be practical about this, right? Not every 20-year-old can save $500 a month. Hey, you're in college. I just said, hey, I was a broke college kid. I sure didn't have $500 to put away. I was trying to pay rent and tuition. And you are expected to make more money throughout your career, right? So 30 to 35. So it's not always a perfect calculation, but you have to look at your balance sheet, look at your cash flow, and understand, how does this relate to my situation right now? How much can I put away? Maybe it's not $500, but if I can start with 200, at least I'm starting early, and we're getting the compounding rolling. All right, so this is time value of money. This is how much time we can stay invested and how much we can save. A quick rule for this, when we're just thinking about investments overall and rate of return, is something that's called the Rule of 72. All right, so have you guys heard of the Rule of 72? Has this concept ever kind of come up? No. So it's simple. If you take 72 and you divide that by your average rate of return, so let's say in this case 7% rate of return, my lump sum money that I put into an investment account should double when I divide those two numbers, so about 10.2 years. All right, so think about that. I put $10,000 away, I can grow it at 7%, 10 years I can expect that to be $20,000. Simple math, simple rules, again, not always what's going to happen, but it's a way for you to think about investment returns over a long period of time. All right, so now we get to what are some of these key drivers of returns. This all sounds great. I can put money away. What do I do with it? It's a funny anecdote here. So when I was working at Merrill Lynch, I was just thinking about this the other day. Every now and then we would have to call our Bank of America clients, right? Because they're all linked together, and we just have to say, hey, we're here to help, whatever. And I had one phone call. I was talking to a bank client. They're like, no, I'm all set. My money's in an IRA. All right, great. Well, I can see their IRA. It's all invested in cash. It's only ever been invested in cash. And I'm trying to say, hey, we need to put this money to work. And they just kept telling me it's in an IRA. It's good to go. Well, cash isn't giving you the returns that you would want, especially when it's in an IRA. So how do we get these investment returns? And this is where we're going to get to the basics of just, hey, what are stocks and bonds, right? You may have heard this all over the place. I kind of want to break this down into something that's maybe a little academic and bring it into the practical side. The academic portion of this is just, why do companies issue stock to begin with, right? Why is NVIDIA saying, yeah, you can own a piece of NVIDIA? Realistically, it's because they want to raise money. That's the reason they're doing it. They're going from a private company, they're going through a public offering. You all saw this potentially a couple weeks ago with SpaceX. right? It was all for them to be able to raise money, raise capital, to reinvest in the business and grow at a faster rate, right? That's what incentivizes these big companies. Well, it opens up investing then to the consumer, to the public sector, to anyone with a phone and a Fidelity app, a Merrill app, a Schwab app, whatever it may be. You can go ahead and buy these securities and own a piece of that company, right? So if I buy a share, that's what this means. I'm representing ownership in the company. So when I was starting my investing journey, I'm a big Formula One fan. Ferrari's a public company. I bought my 2 shares of Ferrari. I own a Ferrari. It's not much, but I can say I'm a shareholder. What that means for you is you participate in the growth of the company, as well as any dividends that they may pay out.
Isn't that what the Trump account is all about, getting the people involved, the kids involved from the beginning, knowing shares and stock?
So it doesn't specifically.
Same thing that he's doing.
Yeah, it doesn't specifically relate to shares, but it is a way for people to start early. I think that's the big incentive there, is to start early. The individual person or advisor managing that account still has to invest it. But yes, that's a big incentive. Hey, let's get this started as early as possible. So why are we buying stock? Well, again, participate in the earnings, get the dividends, and this is voting rights. You get them. I think anyone who's ever received a proxy vote in the mail, I get them through email all the time. It's kind of delete unless you really care about proxy voting. If you're a large shareholder, you should. My 2 shares of Ferrari are not going to give me any pull with the company at the annual meetings, so I'm okay just pushing those off to the side. And then the risk component here in common stock in particular is that if this company does go bankrupt, you're last in line to get paid out. All right, so this is the risk component, meaning they're going to pay their debts first. Basically, everyone else, preferred stock, you're kind of last on the line there, which means if a company goes bankrupt, the price of your shares is probably going to drop substantially. I wouldn't expect to get much money out of a bankruptcy when you're invested in one individual company. All right. The flip side of that is we have bonds. All right. So whereas stocks represent ownership in a company, bonds, you actually have the companies pushing out their debt. You become the lender to these companies, right? So if Apple basically makes a bond offering, you're giving money to Apple. Apple is now repaying you, right? Which is a coupon, which is what this bond is yielding. So in that regard, it's thought of as a little bit of a safer instrument because there is a debt covenant attached to it, meaning you're getting your payment. Well, what we've seen recently is that bonds have their own volatility as well. The bond markets are becoming heavily traded. And the traditional kind of 60-40 we thought about has taken a little bit of a shift. So why would an investor go to the bond market? Really, it's to get that consistent stream of income and try to get a little bit of a hedge against their stock or their equity position. All right? Markets are getting more creative to hedge the stock positions, but traditionally, this is what we would have the bonds for. Consistency, income, right? Getting that payout from the coupon. And this is in comparison to the stocks, because these are debt instruments. If a company goes bankrupt, you're kind of first in line, right? So stocks, you're kind of down here, you're probably not going to get anything. Bonds, hey, you might have a higher probability of a payout because it represents a debt. Apple owes you money when you own their bonds, right? When we go to what actually makes up a stock return, this is one of the misconceptions, and we go through this exercise often, which is what's actually total return. All right, so everybody can understand if I bought a share of Apple at $10 and it's $15 now, my return was those $5. Same thing if you think about some of these other securities that pay out a dividend, right? NVIDIA started paying a dividend recently. So that's factored into their total return, this dividend payout that they're giving you. What's a dividend when it relates to stock? It's a company saying, we did amazing this quarter, guys. We're gonna pay you out as one of our investors, as one of our owners, just a little piece of the pie. All right, so when I'm looking at total return, I'm really looking at how much did that grow, the valuation, my $10 to $15, and then I'm gonna add on top of that what my dividend was. Let's say my dividend was 50 cents. My total return is now at $5.50. It's doesn't sound that difficult when you just put it in a context. You're adding two things, but it is because it's not very transparent. A lot of times you don't really get to see that, especially in the dividend deal, unless you have it going to cash. For early investors, we would typically recommend, hey, reinvest that dividend. So anytime NVIDIA pays you that little share, you're just going right back and buying more NVIDIA. This creates that feedback loop that really builds your wealth over a longer period of time.
Compounding, right? Kind of compounding.
Yeah, exactly. All right, the last piece here, and this is when we're talking about valuations, this is more on the technical side. If I'm buying my share of Apple at $10, but I'm seeing their earnings as saying that it should be worth $8, well then I'm kind of overpaying for something that I'm not getting the return for, right? This kind of gets into the conversation of quality stocks, right? You may have heard of Warren Buffett. He's always over kind of talking about value investing versus growth investing. I'm here to tell you that, hey, it's a mix of the two. They each have kind of their component that we would want to take advantage of. But this is what makes up that total stock return. So what are some of the deterrents in the market, for people investing? Why are we sometimes feeling like we're gambling when we're talking about the stock markets, especially at the beginning, right? A lot of it is headline news. A lot of it is, seeing the fluctuations day by day. Today I made $100. Tomorrow I lost $200. The day after I'm going to get $500. And what we see in the markets is that the short term is volatile. If you're going to be glued to your investment account, looking at it every day, it might give you a little bit of anxiety. We saw that in March of this year. We saw it in April of last year. We had, a month where it flipped from up 8% to down 18%. And you're like, whoa, where's all my money? Well, sure enough, a month later, it all came back up, and it actually started surpassing where we were earlier in the year, right? That's the story of 2025. So this is just an example of COVID as a short-term kind of investment here. You can see that this little outline blue bubble had a 30% drawdown. All right, so if I'm seeing my account decline by 30%, oh man, that gives you a little bit of anxiety there. And what most investors do is pull out of the markets, and oh man, if they pulled out of the markets, I missed out on this amazing return, this amazing growth over the last 2 years. All right, so this gets back to the concept of long-term investing. You're going to feel this in the short term, you're going to feel these drawdowns in the short term, but what we actually experience in the long term is that it's going to follow earnings growth, and earnings growth is consistently increasing. All right, so we're looking here from 06 to 26, so a 20-year gap. We see that the forward earnings per share is increasing year over year. We have some bad years, right? Here we go. We see COVID. Here we see, the great financial crisis. But over this 20-year span, the investments are growing, right? We're comparing here to the S&P. So this is kind of that big picture idea, guys. Short term, you might feel a little bit of that volatility, but long term, markets are going to continue to grow. One of the kind of sayings in our industry and in our business, it's the simplest thing, but it's not about timing the market, right? I'm never trying to go into the best opportunity. It's actually about time in the market, meaning how long you stay invested for. All right, so think about that when you're considering putting some money into the markets and you're not sure if it's the perfect time or not. The perfect time is, especially when you're young, is as soon as you can. Even if you experience a drawdown 6 months from now, 2 years from now, you would have gotten out of that and kept growing. By the way, drawdowns are great opportunities to dump more money in there because you're getting things cheaper.
Money's on sale.
Yeah. Money's on sale. Jane said it best. All right, so this is kind of going into that valuations piece. I think this gets a little too technical. This is more so if you were an individual stock investor, how am I trying to figure out if I'm overpaying or underpaying for an individual stock. You may have heard the term price per earnings, right? This is has historically been what everyone's looking at. If NVIDIA is earning this much, does their price correlate to that? And what I can tell you guys is that even though it's a traditional method, corporate accountants can make up some numbers along the way, especially when there's a quarterly call for these public companies, and they have to give good news every quarter. Sometimes they give bad news, and you see it, tumble down. But price per earnings is becoming less and less of a figure that we can consistently rely on. And it's actually shifting a little bit more to price per cash flow. So if I'm a cash flow rich company, it means, hey, I have free cash flow, I have free cash to grow, instead of just telling my accountant, well, we can push that to the next quarter because we need a good quarter 2 earning call. And then, you're kind of getting into a little bit of, I wouldn't say completely misrepresentation, but you can see the pressures of having good earnings calls every single quarter can potentially skew your data into what's a good buy or a bad buy. That's all this is really saying is, when we're looking for quality, my price per cash flow, if I'm looking for that quality and I'm 8 times, right? My average return is just going to be it's going to be a lot better because I'm getting it on sale. All right, so on the bond side of things, and as early investors or young investors, you may not see a whole lot of bonds. I think it's important just to understand the relationships between bonds and interest rates. All right, the kind of main thing you want to look at here in the bond return, number 1 is going to be your coupon. So how much is this bond paying you out? When you purchase this bond, it's going to have a coupon rate. What that means is that an interest rate. Right, so I bought this bond at 6%. I know that I'm going to get consistently paid out 6%. Okay, if I'm an owner of that bond and interest rates drop, the price of my bond is actually going to increase. All right, so it's an inverse relationship. The way to think about it practically is if I have something that pays out 6%, and now my new issues, or things I can purchase now, are only paying 3%, then what I have is a lot more valuable. My price is going to go up. All right, that's a simple way to think about bonds. It's this inverse relationship. Whenever you hear about the Federal Reserve cutting rates or raising rates, that's the relationship it has to the fixed income market. Again, as young investors, this isn't the most fun space to invest in. But it will become, it will take a larger part in your portfolio as you get older and you're looking for a little bit more income, as well as a little bit more of a hedge to your equity position. Here's just that dynamic. So when the Federal Reserve says, hey, we're cutting interest rates, well, it gets cheaper to lend. So why would Apple pay you a 6% when they can get away with paying you a 3% for a bond issue? That's the relationship that it has with the bond markets. Again, not expecting you guys to go out and seek a bunch of bonds, but I think it's just important to understand the big picture component of it. Okay, so how do we bring this all together into an actual portfolio? And we're going to keep it just simple for today. A lot of this is really just the way we think about investing, the way we think about putting all these things together. The first, it's going to sound like common sense, but risk and return are related. If I'm taking more risk, I should expect more return. If I'm taking zero risk, I'm probably just gonna get a money market rate, right? My 0 to my 0.5% that the bank pays me out for my cash, and my 3% money markets. When I'm looking to diversify, I'm really looking to spread out my risk. I'm not really trying to chase what's the asset class that works best today, because it could change, and it does change year over year. All right, great example of this is 2 years ago, large cap growth was absolutely taking off. This is your Nvidias, Apples, right? Your Magnificent Seven were just doing amazing. The highest performing asset class this year has been in emerging markets. This is international, like companies that are just trying to really break in on an international scale. So outside of the US. This changes year over year over year, guys. Large cap growth stocks, great. Large cap value stocks, great. But if you're trying to diversify some risk, you really want to be looking at these other asset classes and building that portfolio. And then really it's a game of probabilities, right? The markets are uncertain. You're really trying to put all these puzzle pieces together to give you the best shot. So if I'm looking at all of my highest performing asset classes and they're switching every year, I probably want to be somewhere in the middle to the top half in my diversified portfolio if I'm looking for that long-term stability. And you may not be looking for that long-term stability when you're young, but I can tell you as you get older and older and older, it becomes a lot more apparent that you want some of that stability, especially when you start drawing from your portfolio. For now, take a little bit of risk, just diversify it across different asset classes. Really, big theme here is don't put all your eggs in one basket, right? That's really what this is trying to say. These are big picture, some of these asset classes. So global stocks, this is everything that you've heard, all these big companies that we've just talked about today. Core fixed income, these are your bonds. Satellite fixed income is riskier bonds. So you might hear them be called junk bonds. The nice name for them is high yield bonds. That's taking more risk to get a little bit higher coupon. Real assets, this goes back to a little bit of what Josiah was talking about with diversifying across real estate, right? Real estate is a real asset. We can also purchase real assets through funds, so infrastructure. It's just another asset class you may not think about when you're just thinking about markets. Most people go to stocks and bonds. And then finally, we have alternatives. And the reason I have alternatives up here is because I think this is going to become a major theme throughout the next 10 to 20 years. You have heard of it already, most likely. This is going to be the private credit and private equity. So private equity, private credit, hedge funds, private real assets, right? Private companies are now packaging investments and making it easier for the consumers. On the one hand, it provides great accessibility to them. On the other, always be mindful of the inherent risks because they don't have to disclose everything. It's a private company. It's your buddy saying, hey, I'm putting together some money to, build circuit boards out of my basement. All right, that's an alternative or a private position. And then I'll leave you guys with this. This very last piece is just how you can think about investments and throughout your life. All right, so if I'm looking for growth, access, and safety, man, I wish I could get all three. But realistically, you're gonna have to put your priorities and skew them based on where you are in life. All right, so when you're younger, you really wanna go towards the growth. All right, and maybe you can get growth and some accessibility, right, in a brokerage account. The idea here is that these three themes are always going to be at odds with each other. So you can put all your money in a safe money market, no market risk, but hey, you're probably not going to get any growth. You'll have access, safety, no growth, right? Or you can have growth and access, but no safety. So think about this as you're taking on your investment journey, and try to gauge with yourself, right? How much risk am I comfortable with taking, and how much growth do I really need? Do I need to be getting 300% returns, and it also means I could lose all my money. Couple things to consider.
Age plays a role in which part of the training you do.
Correct.
Age is very important.
Yep. So that's all I had today on the investment side of things. I'm going to bring Josiah back up, who's our resident CPA, to talk about some tax basics. But I appreciate you guys listening to me. Thank you.
Thank you, sir. Mark Twain once said, the difference between the tax man and the taxidermist is that the taxidermist leaves the skin. That's a joke for you who are awake and know what a taxidermist is. I'm going to talk a little bit about taxes. I come from the CPA background, so I know a decent amount about the tax code. I help people on a daily basis. Today I disinherited the federal government from $200,000. Love that for me. But we try to understand taxes because it's not just necessarily about how much money you make during your lifetime. It's also about how much you keep during your lifetime. So forgive me, I'm going to take a quick drink of water here. As you can see, there's many different types of taxes. This is certainly not all of them, but you feel like you're being taxed all the time. Income tax is when you make money. Sales tax is when you actually go and buy something, they're going to tax you. Sin tax is this thing on, certain goods like alcohol and tobacco. Property tax is what you pay the government to rent your own property. And investment tax is when the value of your investments increase. So as we talk to people on a daily basis, we're trying to minimize as much of this tax as we legally can. There's a tax triangle. Now this comes really into play when you guys are investing. We can have the same NVIDIA stock in 3 different buckets. You can have it in the taxable bucket, the tax deferred bucket, or the tax-free bucket. Now, before I even explain that, does anybody have an idea which one of those sounds best?
Tax-free.
Tax-free, Pablo, thank you. 10 points for Pablo there. We try to, in this example, move up the tax triangle. As we can see, kind of from left to right is kind of how the money goes into the account and then comes out of the account. For the taxable bucket, it's after tax in, and it's taxable out. So that means you're paying tax on the way in. This would be like your money market account or your brokerage account. You pay taxes on the way in through your paycheck, and then when you actually put the money away and it grows, well, the IRS is going to come and grab more taxes when you want to take it out. The tax deferred bucket is a little bit more advanced here. It's when you get a tax deduction on the front end, but then you have to pay a tax when the money comes out. Give you an example. In most of our 401ks or 403bs or something that our employer allows, you might get a tax deduction on the front end. Well, that's great for 20 to 30-year-olds. Man, I'm getting a tax deduction. That's great. But some of the gray hairs in the room know that if you put $1 in today and it's worth $10 in the future, depending on how long you actually have this in there, well, you avoided tax on $1 and then paid it on the 9. So what's the use in that? Well, it depends on your tax bracket. We'll get into how that might be applicable in the future, but as you guys are young and have the value of compounding, trying to get up the tax triangle. This is where typically you have tax in, but you have tax-free coming out. So, if I put the same NVIDIA stock in any one of these places, this is going to get taxed all the time. This one is going to get taxed on the back end on only the growth portion. And this one typically is going to get taxed only on the front end, and then you avoid tax on the back end. So if you have something that grows over a long period of time, we love tax-free. The 3 environments, here are some examples of different investments that can go into them. I won't spend a whole lot of time on here. Just know that there are a lot of different types of vehicles, right? Like I was saying before, you might have a money market in the taxable bucket, or just your run-of-the-mill brokerage account. You know, you open an account with Fidelity, Schwab, Merrill, whomever. You just go and purchase accounts. Bitcoin is a very popular example of this nowadays. That means that you pay tax to buy this, and then when it grows, even Bitcoin now, you do have to report that on your tax return. Tax deferred bucket, you can see there's things like annuities, which are investments with insurance companies, defined benefit plans, you know, all these workplace plans. Those are very popular ways to get tax deductions in the front end. Tax-free, there have become more and more things that have opened up over the years. I love that one at the bottom there. If you have an HSA, max it out. That's just general advice. It's a tax deduction on the front end, and it's tax-free growth. It's a very rare bucket where you get the benefits of both sides. There's only so much you can put in there, and it can only be used for medical expenses. So you don't want to put all your eggs in that bucket, or that basket, rather. But it's a very good one. But a Roth IRA is another very standard option there. I'll let you guys in on a little secret not many people know. We can actually do a Roth and a 401k at the same time. Inside of most of your workplace accounts, if you have a 401k, your employer will typically have a Roth portion of that 401k. Now, a Roth IRA has a certain limit that you're allowed to put in there every year, about $7,500 a year, and that's going to go up with inflation. But in a 401k, you can put over $20,000 in there at this point in time. So you can do a Roth 401k and really have this huge acceleration of money that you're allowed to put away every single year. Now, capital gains, I'm going to explain what exactly that is because that's important to know as you grow your wealth. Capital gains tax is a tax on the value of your investments as they grow. If you have a piece of real estate, if you have a brokerage account, if you have Bitcoin and it increases in value, the gain on your capital is called a capital gain. Well, the IRS says we're going to come in and take 15% of that. If you go and sell that, 15% is mine, just on the value of the money that's increased. I didn't even do anything to make that money go up, but the IRS says somebody made it go up, so I'm going to have a cut of that. Well, when you work with somebody like us, we know multiple strategies in each of these buckets, but you can do something about your capital gains. You can pay it, which most people do. You can defer it, you can reduce it, and you can avoid it. Now, I won't go into the specifics necessarily on this. There's a bunch of nuance into your individual situation, but there are amazing ways that we can apply tax planning, just using the tax code with what they say that we are allowed to do. Very legal, very above board, very green strategies that fall into all four of these categories. My favorite down there, spoiler alert, is the avoid it, but definitely want to encourage you guys to think outside the box there. I'm also going to talk about when to invest in traditional versus Roths. For most of us, current rates for taxes are at a historic low. I know it doesn't feel that way, but for most of us, we're paying about 10, 12, maybe 20% in taxes on our regular income. Historically speaking, that's actually pretty low. And there's a pretty good chance in the future that your tax rates are going to go up. But as we get into our careers and we're making tons of money and we're all making $1 million a year, well, maybe it's possible that your current rate could be higher than your future rate. That might be a place where you invest in traditional versus Roth. That generally happens later on down the line, but it's good to keep in mind that potentially there is a benefit to the traditional over the Roth. For most of us, though, I'm going to say, generally speaking, Roth is going to be kind of that better option. That's what I got to say about taxes. I appreciate you guys hanging in there, and I see the heavy eyes because nobody likes to talk about taxes. But hopefully you guys have realized that there are different ways to use the tax code in your advantage to keep more of what you guys make. Now, takeaways, big picture here, kind of bullet point pointing everything. For your cash flow, we want to enhance the income, minimize the expense, optimize the surplus. Remember, income minus expense equals surplus, very easy. On the balance sheet, we want to maximize your net worth, minimize your debts, optimize your investments. Remember, net worth is a function of assets and liabilities. And Lewis told us all about how to increase those investments, those assets. And then tax, you want to maximize your knowledge, you want to minimize your tax, and you want to optimize that structure that you use for your investments. So thank you guys very much. Lewis and I will take some questions if you guys want to have anything for the group, but we really appreciate you guys coming out.